Okay, the third company I spoke about at the annual meeting, which we also own in Tarpon, is First Bancorp. First Bancorp, in contrast to both Fiat and Amazon, is not a large position for us. It is one I will occasionally get questions about. The tone of those questions usually, coming in via email and being something to the extent of, "Have you lost your mind? Why do we own a bank in Puerto Rico? Don't you know what's going on over there?" And the answer to all those questions is, in short, yes. I feel like I have a good handle of what's going on. Um, that also really explains, in many ways, why shares are cheap and, by default, why it's of interest to me, or was after I started drilling down. First Bancorp is the second biggest bank by assets in Puerto Rico. We own it because there were just some real similarities between where First Bancorp is in terms of coming out of the credit crunch, if you will, and where Bank of America was when we first bought shares there, where Citizens Republic CRBC was when we bought shares. That was a small bank in Detroit that we owned early on that doubled for us before too long. First Financial Northwest was in the same category. So, I guess what I'm saying is I've kind of developed a little bit of a personal analytical framework for investing in distressed banks over the last 6 years. Didn't really have that on day one when I launched Tarpon or Gecko, but felt like I kind of learned that as I went, and I think it has been a good investment of time and certainly of money in the intervening years. That aside, the framework that I'm talking about when I speak about First Bancorp is really specifically sort of goes like this. It's my experience that the stock market will systematically underestimate the speed with which the earnings power of certain distressed banks will increase after they've successfully mitigated their credit problems, after they've addressed that credit risk to a satisfactory degree. This is going to sound pretty wonky, but it may be of interest for some of you, and it is, I think, a fairly, to me, with my geek hat on, a fairly fascinating aspect of distressed bank investing. Anyway, so this systematic underestimation by the market of the resumption in that earnings power, it happens really, I think, because of the accounting that's associated with what's called loan loss provisioning in general. And that's just really how banks account for, as it probably sounds like, bad loans to a great extent. That loan loss provisioning is both pro-cyclical and backward-looking. Certain distressed banks, the point is, and this really held true for Bank of America, CRBC, and others, certain distressed banks reach an inflection point where credit quality has really materially and dramatically increased, but it's just not at all obvious in sort of a quick review of the income statement. It's one of those things that the algos might not pick up on because there's so many variables involved. And as a result, the market in general can be very slow to realize that these banks are really on the cusp of significant increases in earnings power coming off the bottom of the cycle. So that the whole thesis for First Bancorp is really that they are at that inflection point. They took down TARP funds, they have fired old management, put a new team in there. They've got some private equity money behind them, but all of that I would summarize as saying the pig is almost completely through the python in terms of credit quality. There's a couple of ways to take really back of the envelope but still accurate hacks at what the valuation of First Bancorp should be. One of those ways is based on tangible book value. If you add back what should be the recapture of a deferred tax asset later this year, then there is a significant gap between what shares should be worth on that sort of adjusted pro forma book value basis and where they're trading now. You can also try to value the bank using sort of a more normalized earnings and normalized loan loss provision approach. And if you apply a PE that is far from heroic, shares in that case could be worth close to $9 each. And again, First Bancorp right now is trading in the low fives. There's some catalyst present, a lifting of a consent order. There's a margin of safety and sort of tangible book and the company's key capital ratio. So more of a traditional value investment than, for instance, Amazon might be. And depending on the lens you kind of view that value from, there's anywhere from a 30 to 60% gap between the company's current market price and its intrinsic value. Let me step back a second and sort of geek out again. This may actually be educational. It comes time to look at, or if you're ever examining, for whatever reason, you get bored and want to look at, financial statements for a bank. Provisioning is essentially the act of building loan loss reserves on a bank's balance sheet through an expense line item on the income statement. To greatly simplify one of the sort of key aspects of modern credit risk management at banks, you could say this: expected losses from bad loans have to be covered by loan loss provisions, while unexpected losses have to be covered by the bank's capital. So, not to simplify, there is a really pretty complex relationship between the bank's capital, credit risk, reserves, loan loss provisions. But here is kind of a simple way to think about what's happening on the balance sheet and income statement of a bank once it sort of gets into this exploitable window that I think exists and sort of know it has based on some previous success. If you think about it, when a bank releases its reserves, I'm going to geek out, but just bear with me. When it releases its reserves, the contra asset reserve account on the balance sheet will decline, so gross loans will go up, and then assuming the liability side of the balance sheet stays the same, or it increases less slowly, then the book value is also going to increase. In addition, when loan loss provisions, which are on the income statement, when those decline, and again assuming reserves are declining at the same rate, then the earnings of the bank will also get a boost, all things being equal. All of which is sort of a long-winded, admittedly very geeked out way to say that that earnings boost will also filter through and increase book value on the balance sheet as well, of course. So the point is this: for distressed banks like First Bancorp that have successfully mitigated their credit risk and have enough capital, which is also one of the key factors here, the potential increase in book value per share for those banks as they're coming off the bottom of the cycle could be very accelerated, and that's specifically thanks to boosts from both the balance sheet and the income statement impacts at the same time. And I think I'll just leave it at that because I probably lost a whole bunch of you. But this sort of stuff gets me unreasonably excited, and hopefully it does some of you too. We own First Bancorp, and hopefully you stuck with me through that. All right, let's shift gears and bring in Rets here. Let me step back big picture wise. One of the neat things I think about IIM right now is we really have sort of two philosophies to benefit investors here. I think it's no secret that I've been a big Buffett fan, so since day one we've kind of had that Buffett, although tailored greatly for me, approach to the world. Once Loretta came on board, she brought with her really a Templeton approach, specifically to international investing. Sir John Templeton is the Warren Buffett equivalent of investing on the international scene, essentially. They're both value investors. Studying both will give you a pretty broad range of what it means to actually be a value investor. Similarities between Buffett and Templeton could probably be boiled down to 4 or 5, like here. Again, they're both value investors. IIM will forever be a value shop. They're both stock pickers, Buffett and Templeton. They both rely on deep fundamental analysis, geeking out even more than I do about loan loss provisions at banks. And they both really construct bottom-up portfolios, and by that I mean they're not, overly influenced by macro events. What really matters is what's going on at the company-specific level. Here is sort of a back-of-the-envelope quick way to sort of capture what Buffett emphasizes, and this is probably, as you can tell, a setup for a contrast that's going to come next slide. These general ideas, which I've talked about before, you know, there's no surprises. Buffett emphasizes intrinsic value, discounted cash flows, asset value in many cases, like our old friend Clearwire from a few years ago, competitive advantages or moats, and essentially good management. And that's a good segue to bring Retz in here and let her talk about philosophy 2 in John Templeton.